Investing is one of the best methods to grow your money over time and reach your financial goals, but you shouldn't go into it expecting to get rich quickly. Long-term wealth creation has shown to be the most dependable method in history. To understand how, continue watching the video to the finish. Hello, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. In today's episode, we're going to learn the best investment strategies. Before moving on, subscribe to the channel and smash that like button. Now, without wasting much time, let's get started. The best investment strategies aren't generally those with the highest historical returns. The best ones are those that fit your goals and risk capacity. Investing methods and tactics are similar to the best fitting clothes. You don't need anything expensive or custom-made. You require something comfortable and long-lasting. This is especially true if you're making long-term plans. Don't start an investment strategy and abandon it for some new hot trend you discovered online. Stick to the tried and true essentials. Determine which of the finest investing techniques is right for you. How do beginning investors invest in stocks? Beginners can begin investing in stocks by opening an account with a low fee or no fee brokerage service. These brokerage firms will not charge the investor when he or she deposits, trades, or withdraws funds. In addition to registering with a brokerage business, you can use the information on the broker's website to begin investigating which asset classes and securities are of interest to you. How can I create an investment strategy? A basic investing strategy is developed based on your long-term objectives. How much money are you attempting to save? What is your savings timetable? What are you attempting to accomplish? Once you've established your financial objectives, you may set targets for return and savings and then look for assets that fit within that strategy. For example, you might want to save $1 million. To reach this goal, you must invest $10,000 every year for 29 years and earn an annual return of 8%. With this information, you can study historical investment performance to locate an asset class that meets your strategic objectives. Active trading. Ride the wave with active trading. They believe that visitors should continue to win and losers should continue to lose. They seek out equities that are on the rise. They may choose to short sell losers if they anticipate that they will continue to fall. Technical analysis is used by the majority of active traders. This research tool focuses on changes in stock price rather than measurements related to the underlying firm. As a result, you might benefit from significantly shorter-term movements. You have the opportunity to use leverage in your strategies. You can use this trading method in any time frame, including months, days, minutes, and even seconds. Use price data from charts that's used to forecast future price fluctuations. To improve your chances, you must establish parameters for risk, rewards, and win-loss rates. You can also use momentum investing, a slower-paced variation of aggressive trading. According to the method, tendencies arise even with random price movement. You might make longer-term investments with the hope that momentum will build and the price will continue in the same direction. The concept is to buy low and sell high. A mutual fund manager, for example, may select growth equities that have exhibited persistent price appreciation trends, assuming that the growing price trends would continue. Growth investing. One of the oldest and most fundamental methods of growth investing is fundamental analysis. This is a strategy for active investment. It entails examining financial documents and information on the firm behind the stock. The goal is to select a company with the potential to grow in the next few years. This investment strategy seeks to build a portfolio of 10 or more individual stocks. If you're a beginner, the research required to make this technique a success can take a long time, but it's what many fund managers employ to generate returns. Growth stocks frequently outperform during the mature stages of a market cycle. The method mirrors what investors do in thriving economies: raise their expectations of future growth and spend more money. Tech businesses are excellent examples. They are frequently overvalued, but when the conditions are favorable, they can outperform those prices. You will evaluate data from a company's financial accounts if you choose this technique. You may arrive at a value of their shares as a result of this. This will assist you in determining whether the stock is a worthwhile buy. Who should invest in growth? Growth investing is inherently riskier and thrives only during specific economic conditions. Growth investing is better suited for those seeking shorter investment horizons with greater potential than value investing. Growth investing is also suitable for those unconcerned about investment flows or dividends. The difficulty, of course, is predicting when these sub-periods will occur. While it's not wise to try to time the market, growth investing is best suited for investors who believe that strong market conditions are on the horizon. Value investing. Value investings are avid deal hunters. They look for stocks that they believe are cheap. They seek stocks whose prices, in their opinion, do not properly reflect the security's true value. Value investing is based in part on the assumption that there is some irrationality in the market. In principle, this irrationality gives opportunities to purchase a stock at a bargain and profit from it. To uncover bargains, value investors do not need to go through mountains of financial data. Thousands of value mutual funds allow investors to purchase a basket of equities that are deemed to be undervalued. For those who don't have the time to conduct extensive research, the price-earnings ratio has become the primary instrument for swiftly discovering undervalued or cheap securities. This is a single number calculated by dividing its share price by stock's earnings per share. A lower PE ratio indicates that you are paying less for $1 of current earnings. Value investors target companies with a low PE ratio. Who should make use of value investing? Value investing is ideal for investors who intend to hold their shares for an extended period. If you invest in value companies, their businesses may take years to scale. Value investing looks at the larger picture and frequently strives to approach investors with a growth mindset. Consider Warren Buffett's statements after making a significant investment in the airline business. Airlines, he added, had a horrible first century, and they got that century out of the way, I hope, he added. This mindset typifies much of the value investing approach. Decisions are made based on decades of patterns and with decades of future performance in mind. Value investing has provided higher long-term returns. However, value investment has underperformed growth investing over extended periods. According to one Dodge & Cox analysis, value strategies have fallen behind growth strategies during 10 years 3 times in the last 90 years. The Great Depression, 1929 to 1939, or 40, the technology stock bubble, 1989 to 1999, and the years 2004 to 2014-15 were those times. Indeed, value investment has persistently underperformed growth investing since 2007, resulting in a 50% downside through 2020. It's unclear whether value stocks will regain their luster in the near future. Purchase and hold. Buy and hold investors believe that time in the market is superior to market timing. This technique entails purchasing securities and holding them over extended periods of time. Long-term returns, the theory goes, can outperform short-term volatility. This method is diametrically opposed to market timing. The buy and hold investor will claim that investing for longer periods of time necessitates less frequent trading. Trading expenses are reduced. This will boost the portfolio's overall net return. Lazy portfolios are those that use the buy and hold strategy. This is due to their passive personality. Satellite and core. A common portfolio design is a core and satellites. It's made up of a core, which includes large cap stocks and index mutual funds, which accounts for the majority of the portfolio. Other sorts of funds, known as satellite funds, are made up of smaller portions that combine to form the total. The primary purpose of this strategy is to reduce risk through diversification while outperforming a traditional benchmark, such as the S&P 500 index. This type of portfolio should produce above-average returns while posing a below-average risk. Dave Ramsey Mutual Fund Strategy. Dave Ramsey, host of the Dave Ramsey Portfolio Talk Show and financial guru, promotes a 4-fund plan. Dave's wisdom can be found in his simplicity. His approaches are simple to understand. The wisdom, however, ends there. These 4 mutual funds categories frequently have fund overlap, resulting in little variation. Furthermore, lower risk assets, such as bonds and cash, are not included in the portfolio. Contemporary portfolio theory. Modern portfolio theory is a strategy of attempting to take the least amount of market risk in order to maximize profits. If you follow the MPT tenets, you can use the core and satellite techniques that we were going to talk about. Modern portfolio theory. MPT considers the risk to be symmetrical. The portfolio is made up of various different investments. These have varying levels of risk that work together to produce a reasonable return. It provides a more comprehensive understanding of risk and reward. A PMPT investor considers the risk to be asymmetrical. They do not consider losses to be the inverse of gains. Each habitat is distinct and ever-changing. According to PMPT, investors do not always act logically. PMPT considers the investor herd's behavioral features in addition to the model that MPT employs. Retirement investment strategies. A patient, well-informed approach to investing can lead you to financial independence and considerably improve your quality of life in retirement. Some of the most popular investment products that can help you accomplish your financial goals are specialized retirement accounts. Roth retirement plans do not provide tax benefits each year, but they do allow you to receive tax-free withdrawals in retirement. Tax advantages exist for both types of retirement savings accounts. Contribution matching programs for 401ks and other retirement plans are offered offered by some employers. Taking advantage of employer matching as soon as possible can considerably boost your investment performance and give you a much better financial pedestal in retirement. If you can't afford to invest money to take advantage of your employer's retirement matching program, your aim should be to maximize the matched contributions or free money from your employer. Even if you follow the preceding recommendations, investing in the stock market always involves risk. Make today the day you begin expanding your money and laying the groundwork for long-term financial prosperity. That's it for the video, guys. Hope this video provided some great info. Press that like button if it did. Comment down which investing plan is the best for you. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.